Hey guys, I didn't add myself to the stage, so this is probably the first words you're hearing from me. I've been just talking and talking and talking, and you know nobody's there. So here we go. So I'll start it all over again. Hey guys, this week is going to be kind of fun. So we're going to be talking about this model that I began putting together in September of last year. What I was looking for, I got tired of kind of falling in love with stocks and not really knowing when to fall out of love with them, if that makes any sense. So I began to build a model of data, and I pulled data from the various apps that I subscribe to. Um, so hopefully you guys can hear me. Let me know if you can hear me in the chat here. So yeah. So good. El Dynamico, can you hear me, my friend? So yeah, let me know. And just want to see if you guys are actually hearing me. Oh yeah, good deal. Thanks, Rust. So anyway, I wanted to find out how I can know which stocks to fall in love with and when to fall out of love with those stocks. Because I've got a history on a couple, 2 or 3 stocks that I just should have just cut bait and run. You know what I mean? And we all have that. So anyway, I've got this model. I want to share that with you guys tonight. I want to share with you what I look at, why it's important to me. And then I want to share with you the picks. So to put a little timeline in place, I started this model. I built the model in September. I tested it in October of last year, and actually made my first official picks in November. So I want to share the picks that I made from November to now and how those picks have done compared to the S&P 500. So that's kind of like a report card. It's kind of like a scorecard, if you will, for the picks. And so anyway, I think it'll be kind of fun. There's some things that I still need to work on, but at the end of the day, I really, really like where this is going. So, and then after that, we will talk about whatever is on your mind this week. I know we got a lot going on. We got the big April 2nd date that's coming, and I've got a few thoughts on that I will share. And so with that, let's see who all is on the program tonight. If you're watching, just give me a shout out here so I'll know you're here. So we got Shannon, who is here from Atlanta. Good to see you, my friend. Yeah, the bad storms, we got those last night. Actually, it was in the middle of the night, I think somewhere around 4 or 5 a.m., and they were pretty bad. So I understand what you're talking about, my friend. Those are some bad storms. Well, I'm about 4 hours to your west. So, it probably took a little while for those things to get over to you. My friend Pat is here. It's good to see you, Pat. And Billy Johnson, all the way from overseas. He sent Russ to my house looking for me. I didn't see Russ, but, those Chicago guys, they might get lost here in the South. They made us not know where to look. So, we'll see. I don't know. Maybe he'll show up. If he does, maybe he can join me here on the show. So, yeah, so Pat had some ice storms. I saw some of those on social media, and those look pretty rough. I did not like ice storms. So, Michael Swami is in the house. Good to see you, Michael. It's always a fun time when Michael's here. Rust Moments. Now, Rust, correct me if I'm wrong, but I think I caught your live stream today. So it was a fun time. I appreciate you doing that. It was fast and furious. So let me know if I got the right one. So let's see. Tomorrow's going to be okay. Yeah. So Pat's going to have some cold weather. You know what, Pat? I don't want to rub it in or anything, but I hear that Wednesday, 2 days from now, it's supposed to be 87 degrees here. That is blistering hot, my friend. Let's see. Yeah. Yes, the screen was blank. That was my fault. I was talking for several minutes and had not actually added myself to the program. So it's a little rusty, right? I'm a little rusty, so you guys gotta stay with me, and we'll see how well I do the rest of the program. Let's see. Yeah, I definitely know how to clear a room, my friend. It is very easy for me. I have done that all of my life. So El Dynamico is here. Antonio, it's good to see you, buddy. Let's see. John J has made it. He made it to the live stream. Since I'm over 50 years old, what's your model of preservation? Yeah, I can talk about that. I think it's kind of wrapped up in this model. So I'm going to make a little note here. I actually wrote presentation, but it's preservation. Is that self-preservation or portfolio preservation? I think you probably mean portfolio. So we'll go with that. Suzuki Man is in the house. Good to see you. Good, El Dynamico. I'm glad you can hear me, man. I would hate for all of these vibrations from my voice to actually go upon nobody. So, and some of you guys would probably rather they didn't. So, drinking iced tea tonight, not out of a bottle, out of an actual glass. Very nice, very refreshing. Let's see. EOD, MCD did his thing today. Yes, they did. So that's another good question. Yeah, there's been all of this discussion about SCHD. Let's when we get to my portfolio, let's take a look and let's see if there's any SCHD in that portfolio. And I'm happy to talk about that. Let's see here, John. Word the chickens and bees took you hostage. No, they didn't yet, but I think they're conspiring. Yeah, I was a no-show for 2 weeks in a row. We had some visitors from out of town 2 weeks ago, and then the SCHD discussion last week was on Monday night, and I just felt, and even though they were going to end right at the start time of mine, I just felt that you guys would probably be burned out. So and then I really had every intention of doing one later in the week, and it just never happened. So here we are. We're Monday night. We're back together again. Everybody give a big group hug. And so we're back. Let's see. Michael, directions to Kevin. Go to the holler, then turn at Tom's Liquor, turn off the paved road, look for the bees. Yeah, that's it. That's it. Yeah, go past the elm tree. 3 elm trees on the right, and you're there. So good job, man. Oh, good. Yep, that was from his Nathan account. Rust has so many names that I tend to forget some of them, and so. But yeah, it was a great program, man. If you guys have not stumbled across Nathan's Rust's Shapings account live streams, you should do that. It's a good time. And Oscar is here. Way to go, Oscar! It's good to have you, my friend. And so let's get started, man. We like to be productive on these things, and so much so that I forgot to pull up the shared screen, but I will remedy that right quick like entire screen. Oh, there it is. There we go. Share that bad boy. Here we go. Let me get Oscar off the show here. All right, so here we go. We got the wealth circuit investing. We're going to talk about stock picking tonight. And, when I think about stock picking, there are, oh gosh, I think I'm going to get this wrong, but I'm going to be pretty close. There are around 20,000 investments in the markets. That would be the NASDAQ, the NYSE, the American Stock Exchange, and, others that you can choose to put in your portfolio. And I know some of us think that somewhere from between 15 and 30 stocks is a reasonable portfolio. Some will go as high as 100. But so let's say that you go as high as 100. That's 100 stocks, 100 investments out of 20,000. How do you pick that 100. So it's a big question for me, and it's something I've struggled with for quite a while. So I thought I'd build a model to help me with it. So here we go. But before we get into the model, I want to talk about where the portfolio is year to date. And if you want to look here, as of today, as of the end of market today, the portfolio is down 0.47%. So about a 0.5% off of our year-end figures. So, I'm pretty happy about that. Obviously, I'd love to see it green. This past Friday was not a great day. I think we went down about 1% and caused us to go into the red. But, we've been flirting around break even for a while. Let's compare that now to the S&P 500. S&P 500 is down as of today 4.26%. The NASDAQ down 10.29%. The Dow Jones is actually performing pretty well. It's down 0.85%. And then last but not least, we have the Russell 2000, and it is down 9.58%. So, you know what? I will take being down 0.47%. That's close enough to break even for me. And, we'll see where the rest of the year goes. But my portfolio, I like to think of it as having some shock absorbers in it so that I don't go down as far as the market. But then again, I don't go up as far as the market. So when the market's doing this, my portfolio might be doing this, right? And so it kind of keeps me from getting whiplash as an investor. So anyway, that's kind of the way I do it. That's probably not the way a young investor should do it because, I'm looking to kind of eliminate volatility out of my portfolio, which might over time limit returns. Although I will say since the beginning of 2022, which is when I started measuring this, the portfolio over that length of time is still ahead of the S&P 500. So I haven't given anything up in the long run for having this performance style, if you want to call it that, this portfolio style. So with that, let's move on to, I want to share with you guys this model here. Now, I've shown this before. I'm going to make this bigger so you can see it, but I really have not delved into this. And I want to talk just a bit about what this spreadsheet does for me. So I have an Excel spreadsheet. It has roughly 100 stocks in it that I track. I do add to it from time to time when I run across a company maybe I've not seen before, or maybe is beginning to perform well. Maybe they've changed their strategy and things are looking good for them. I will take that and load it into this file. I also have stocks in this spreadsheet that I probably would not invest in, but I know which ones they are and I know why. So, and I might talk about one of those here in a second. It's actually one of the top ratings in the program, but yet I'm not investing in it. Why is that? You'll have to stick around and find out. So, there's about 100 stocks. I look at really three things. There's three things I want to know to be objective. I've done research on pretty much all of these companies, so I understand their strategy. I may not be up on some as I am the ones I'm investing in. So if I'm not investing in it, I might not listen to the quarterly calls or keep up with that. But I understand where they're headed, what their strategy is. So what I look for are three things. And you'll notice that here in the spreadsheet, it shows what the stock is, whether I own it, whether I consider it to be a buy, sell, or a hold, what percentage of my portfolio it is, and what I call the annual return potential. And we'll talk about that more here in a little bit. I also am able to pull what the analysts believe will happen over the next year. That's their average return potential. And I like looking at both. I might have missed something. There might be something out there that the numbers just don't uncover. This is a good way for me to kind of balance that and go, wow, why am I showing for Realty Income, You can see here on line 19, I'm showing 16%, and the analysts are saying 11%. Why? Why is that? So, and actually, it's I would look for bigger changes than that. But so I have my thoughts in column E and the analyst thoughts in column F. Then a couple of other things before I tell you what I kind of look at. One is I bring in the Morningstar moat rating. I bring in Morningstar's fair value, and I look at what percentage of that they are. I look at whether they're undervalued, overvalued, or fair valued. I look at their return on invested capital. That's a key number for me. And then I also pull in Morningstar's assessment of their fair value uncertainty. So how quickly could their fair value change if things didn't happen? I also bring in Simply Safe dividend safety rating. Okay, so with that, here we go. These are the things I look for. And it's going to sound really simplistic, and that's why I've been a little bit hesitant to share it, because it is a bit simple. But simple sometimes is sophisticated, right? So here's the three things. I look at valuation, I look at yield, and I look at future growth. And how I get there is I look at, if they are undervalued or overvalued, I know it is rare for a company to recover its fair value in a 1 year period of time. So I have done some, gut checks, I guess. And I have a formula that I say, it's not going to be 1 year, but it's going to be some number of years that they will recover their fair value. So as long as when they're under their fair value, I believe that they're going to get back to that at some point. If they're over it, I believe they're going to come back to that at some point. So that's, it's about fair value. It's about coming to the intrinsic value of that stock. So if it's undervalued, I think they're going to do better over the long run than somebody who's overvalued coming back to their intrinsic value. The other thing is yield. Yield happens every year. Yield happens, they pay dividends, they are going to have that yield every year. So if they're coming back to fair value, I have their yield, which is income. And then I look at their dividend growth. Now, dividend growth, what it tells me is, what do they believe the company is? How much do they believe the company's going to grow over the long term? Because having sat in boardrooms about dividends and how much dividend to pay, part of the discussion is, what are our long-term forecasts and what do we believe our strategy is going to do? Can we support a raise in dividend this year that we would then need to raise again next year, the year after that, the year after that? So I know a lot of folks, I hear a lot of YouTube video folks who will say, their payout ratio, which is the amount of dividends divided by the earnings, is really low. So they have room to raise the dividend. I don't really think about it like that. The way I think about it is, I want them to be growing the business at such a steady pace that they can grow the dividend and keep that low payout ratio. I'm fine with a low payout ratio as long as they're growing the business to support the dividend. So there we go. It's about recovering fair value. It's about dividend yield, and it's about dividend growth. So, and I use dividend growth as a proxy for business growth. And as long as their payout ratio is pretty flat, that means that any dividend increases that are happening are coming from growth in the business. So I think that's a good way to look at it. Now, so I put all that together, and you can see I just add them together. So here's Novo Nordisk, who's at the top of the list. And I know they've been taking a beating here as of late. But I'm saying, hey, they're going to recover maybe 7% of their fair value. They've given me a 2.3% yield, and they've got dividend growth around 18.6%. Add that together, that's 28%. So why don't I just invest in Novo Nordisk? And it's because I'm not sure I'm not sure what the future of drugs like Ozempic are going to be. I don't know. I haven't really done enough research to know that, that it's a really winning strategy, or if it's a fad, or what. So the market is really taking it behind the woodshed and giving it a big spanking out behind the barn. So, but at this point, I'm not interested in it. It is on my list and it's on the watch list, but I do not have it as a buy rating and don't plan to add any here anytime soon. So, if one more thing before I go too far, I want to talk about this annual return potential. I don't believe that. So, for instance, Novo Nordisk 28%. I'm not saying that I think they're going to grow by 28%. Oh, by the way, analysts are believing 54%. So there's you got that going for you. But I'm not saying that Novo Nordisk is going to grow 28%. But what I am saying is relative to Alphabet, relative to ConocoPhillips, the numbers are telling me that it's going to grow a little bit more than Alphabet, ConocoPhillips, Amphenol. I just don't know that I like their strategy. So there's a lot of investments out there, and you guys may love Novo Nordisk, and I'm happy for you if you're buying that. The numbers look great. It's just not an investment for me. And I'm not saying that you guys shouldn't invest in it. I'm just saying that this doesn't work for my portfolio. So with all that said, you can see here that I have this week some buys. These and again, these are for my portfolio. They may or may not be buys for your portfolio, but they might be ideas for you to research. So my buys this week in order are Alphabet, ConocoPhillips, Amphenol, Microsoft, Carlisle Industries, or companies, I guess, T. Rowe Price, and United Health. Those are my 7 buys for this week. We're going to talk about that here in a little bit, but I go through each week, and if I've added companies, I add all that data in, but I look each week and I think through the strategy. I look at any recent information about the company, and I look at what analysts are thinking and what I'm thinking, and I make a determination out of my 100 stocks, which ones are a buy rating. And I don't have to have any. It's not like I say, oh, every week I want to have 4, every week I want to have 7. It's just based on what the market is giving me. So these are my 7 buys for the week. Now, one quick thing. Here's my report card. I'll hide this at the bottom because it doesn't matter. Hide. All right. So let me make this bigger too. You can see here that, and so my first real week was November the 4th. You can see that I did, how many is that? That's 8. I had 8 recommendations that week. The way I do it, I'm really looking at the long term. So I may not have different ones every week. They may be the same every week. I might not even change anything, right? I might have the same recommendations from one week to the next. But what I decided to do is to measure the performance of the stock that I'm recommending from the first date that I recommend it to today, and then compare that to the S&P 500's performance over the same period. So I've got, let's see, 16, I think. I've had 16 recommendations, currently have 7, which are these yellow highlighted ones. And so if I look at this, I've got on November the 4th, well, let me just kind of come over here to the change versus the S&P. You see this column here? This means that for ConocoPhillips, when I recommended it, it has gone down 5.9% from the very first time I recommended it. The S&P 500 has gone down 6.6%. So it has actually overperformed the S&P 500 by 0.7%. I have that as a yellow. It's kind of like, it's just right there with the S&P 500. But take a look at Elevance Health. It has actually grown by 2.9% over that same period. The S&P 500 is down 6.6%. So it is actually 9.5% better than the S&P 500. Now, I've got 2 losers in this whole list of 16, and they are Google and Microsoft. I'm not concerned about them over the long term. They are underperforming the S&P 500, but, for the last couple of years, they have overperformed it. So I don't think this is, a total surprise to any of us. But from a model perspective, it I did recommend it on November the 4th, and that was the price at that particular time. But take a look at this. We got Hershey. I started recommending it on November the 4th. It's 3.9% better than the S&P 500. Hess Midstream, you guys know I've talked about them. This is that it's a oil and gas transportation, a midstream company for oil and gas. They have gone up just price-wise, not including the dividend. They've gone up 20.6%. S&P 500 is down 6.6. So that means they are 27.1% better than the S&P 500. So that's really cool. So let's move on. Verizon was one. They're about 18.6% better than the S&P 500 from when I recommended them. They're currently not a recommended company, but I've decided I'm going to leave these on here because it's really about a long-term perspective. I want to look from a long-term perspective how my picks are doing in the market. So this is over the past, November, December, January, February, March. So 5 months. Over the past 5 months, this is where they stand. Chevron is up 13.2 versus the S&P 500. Realty Income, I recommended on November the 11th. It's 7.2% better than the S&P 500. Northrop Grumman, I recommended on November the 18th. It is 9.2% better than the S&P 500. MasterCard, I recommended on November the 25th. It's 10% better than the S&P 500. United Health is on 12/16. It is 10.4% better than the S&P 500. Now we're getting into some newer ones. Carlisle, the first time I recommended that was December the 23rd. And you can see that it actually went up after that. These trend lines are kind of fun to watch. But it has come down and it stayed down. But it's about 2.4% worse than the S&P 500. Pepsi, I recommended it in January, on January 27th. And it is 6.6% higher than the S&P 500 over the same time period. And then Amphenol is right at the S&P 500. It is 0.9% better. And then T. Rowe Price, I just started recommending that March the 22nd. So this is, I guess, the second week that I've, and you can see the trend line here has 2 points on it. So I've recommended it for the last 2 weeks. It has moved about 0.2% better than the S&P 500, but it's probably going to stay on the list for a little while. So anyway, this is my report card, guys. I don't know. Let me know what you think. Got any questions? Anything that out of that might be helpful to you guys? Anything that you think that I could do differently, do better? So I do plan to make some iterations of this. So we'll just have to see. Let me come back over and see how you guys were doing. Let's see. Let me come back up here. All right. So Pat was up 0.95% today for an all-time high. That's fantastic, Pat. I think I was only up 0.54. So well done. Well done, my friend. It's probably, kind of warmed you up a little bit with all that cold weather you guys have been having up there. Let's see. I bet Whirlpool is the, he wouldn't buy, not to spoil it. Yeah, just no way Kevin would own that. Yeah, so I used to own it, but Whirlpool. Let me come in back to the stock listing here. Get it out of the buy recommendations. Go ahead and pull the holds back in. So here's an example. Whirlpool is a company I had fallen in love with at one time, but it was just not the right company. And it's, even though it's showing up here as something to invest in, I know now that it's not the right company. Lamb Weston is also floating to the top, but I've identified that from a management perspective, they are struggling, and I don't know that I would invest any more money in Lamb Weston. I'm not selling what I have. It's at the value it's at, and so I'm gonna go ahead and keep it. Hopefully, over the long term, it'll come back. But actually, the one I want to talk about, and the one I don't buy, is Comcast. because I know some of my friends are real big fans of Comcast. I owned Comcast several years ago, and the numbers are phenomenal. So I certainly get and I understand why people want to invest in Comcast. The numbers are incredible, huge cash flow, growing dividend. I mean, it is really phenomenal. But when I began to look at their strategy, they own a lot of different things. They have, Universal Studios. They have the Sky Media Group over in the UK. They have a lot of different things that they're investing in, trying to get into this next level of communication. But as their Wi-Fi or wire, what do you call that now? Cable, as their cable business begins to drop, they need something to grow, and they're really struggling trying to find that. So until I'm convinced that Comcast is investing in the right things for the future, I'm not investing in Comcast, even though my model would say that's not too bad. You should invest in that. So the point is that there is judgment in this. I don't just look at this model and say, "Oh, that hit the top of my list, so therefore I gotta buy it." I don't do that. I still use judgment. But if I had fallen in love with, let's see, let me find one that I fell in love with at one time. I fell in love with Best Buy at one time. It's down here around 51, so it's about halfway down the pack. And, like, for instance, the analysts love it. They say it's going to grow by 31%. But, maybe I fell in love with Best Buy again, but I wouldn't buy it because it's halfway down my list. There's much better stocks for me to pick from than Best Buy. And it kind of keeps me out of this emotional thing. Visa, I love Visa, but they are way down the list. It's not time to buy them right now. Their valuation is just too high. So it keeps me out of the emotions, if that makes any sense. So, all right, let's see here. Oh, let me do this. Dun, da, da, da. You must got gold or some golden stocks. Yeah, that's right. Yeah, Shannon, I think that's right. I think it reverts to the mean. It doesn't mean it will be a V-shaped recovery, right? It doesn't mean that they're going to drop in value and then come right back to their intrinsic value. But I think over time, as long as the intrinsic value has some validity to it, I believe the management team is going to do what it needs to do to get the company back on track. And it will take some time to do that, as long as there's a strong management team, which is why I'm a little bit PO'd, I guess, at Lamb Weston. I don't think their management team's that great. They just hired a new CEO, so I'm holding on, waiting to see if maybe that person brings some fresh life to Lamb Weston. But yeah, I think, Shannon, that's a great way to think about it, is from a fair value perspective. It seems to make sense to me that companies will go above their fair value and will trade below their fair value throughout their lifetime. So if their fair value is here, they're going to trade above it, they're going to trade below it and above it and below it. So it's always going to revert to the mean. And I think us value investors, that's one of the things we believe in, right? So yeah, so that's a good way to say that. I appreciate you sharing that. So, El Dynamico, if we're looking at future growth, wouldn't Realty Income be out of the competition? I mean, it's really not growing anymore, is it? That's a great point. So let's pull up Realty Income. I think what I'll do is I'll hide everything else so it's not as confusing. And I know you won't be able to see this, Antonio, but I will speak to it. So Realty Income, from the info that I have, so I have it as a 16% annual return potential. The analysts are saying it's about an 11% annual return potential. It has no moat because basically it's just holding real estate assets. It doesn't have a moat. Percent of fair value is 77%. So really, well, we'll talk about that here in a second. Return on invested capital is kind of what scares me away from Realty Income. It's only 3%. I know it's real estate investment company, but still, that's just really low. It's got a low uncertainty and a dividend safety rating of 80, so it's certainly investable, and I know it's done well this year. It went up 2.47% today. But it is a safety stock, right? So anytime there's uncertainty in the market and there's a flow into safety, companies like Realty Income are gonna do well. There's just no doubt about it. So where my 16% comes from is they have a yield of 5.6%. So they're going to give me income. If nothing else happens, if they don't grow the dividend at all, if they don't, if they trade at their fair value forever, they're going to give me 5%, 5.6% in yield. So I'm going to get that off the top. They're according to Morningstar, they are undervalued. So I think that a portion of that is going to come back. And then they do have dividend growth of 2.9%. So if you put those three together, you get 16%. Not a bad investment. So, but it's just hard for me to invest in it with only a 3% return on invested capital. But it's near the top of my list, so I can't throw rocks at it. It's got some pretty good company where it is. So, all right, where are we at here? My weighted average year-to-date return is about 5%. Man, Michael, that's fantastic. Much of it due to AbbVie. Yeah, great job, man. That is a fantastic return. Biggest gainers were Realty Income. Yeah, so all of these safety stocks, right? So Realty Income, Altria Group, SCHD, Verizon, ADC, which is I think Agree Realty. So all of those are safety related, defensive kind of stocks, and they have all done well this year. So, I think, you guys being in those has just been a great thing this year to date. And so, who knows? They may continue to do well the rest of the year. I just don't know. I don't know what's going to happen. If I did, I'd be super wealthy. So let's see. Bum, 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 bum. Gendries, good to see you, my friend. I've missed you guys, man. It's been a long dry spell. That's what we say down here in the South. It's been a long dry spell. So, and Bernard is in the group. Hey, I appreciate you, buddy. Yeah, I hear you, Billy. Whirlpool beat me up as well. I did sell out of Whirlpool and took a loss. I think it is my biggest loss ever. And you guys know I'm pretty transparent about my investments. I'll tell you whether I make money or lose money. It is what it is, right? I'm not trying to impress anybody. My goal here on this channel and doing what I do is not to tell you how to invest, but to let you know how I'm doing it. And if there's anything I'm doing that you like, you can steal it. I don't care because I'm here to help make everybody better. If there's things that you see that you don't like, then don't do them, right? And so I think that's a fair proposition. So if I can give you some ideas on some stocks, if I can talk about how I do certain things, why I do certain things, and that kind of spurs something in your creativity, I think that's fantastic, and it is the reason that I exist here on YouTube. So, all right, good stuff, Billy. So yeah, we're together, man. We got beat up together. Whirlpool took no prisoners. Oh, my buddy Russ. Hey, somebody said that you were going to come down and find me here in Alabama. I told him that I didn't think a guy from Chicago could find me down in the deep South. So, hey, have you ever heard the idea that if you wouldn't buy any of your holdings right now, you shouldn't sell them? Yeah, I have heard that. I don't necessarily espouse to that, but I mean, I get the theory. The theory is that a stock's value is what its value is. And so, yes, if it was trading yesterday at 100 and today it's at 50, then by keeping that stock, if you don't sell it, by keeping it, you're buying it at $50. So I certainly get that. And, I could say that about Lamb Weston, right? It is currently trading at, let me get my spreadsheet over here. Dun, 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 dun. Currently trading at 53.30. So every day I'm buying that for 53.30 because I could sell it for 53.30. But sometimes I just like to let things it's kind of like making a stew. You kind of got to let things kind of run together and kind of let them boil a little bit. I don't really I don't really think about wanting to sell all the stocks that I have every day at the prices that they're in the market. So let me kind of maybe boil that down and be a little more clear on where my position is on that now that I've thought through it. It's I like the theory. I understand the theory. I think the theory is right. But what I don't like is that it drives me to the place where I'm thinking that I should sell my stocks every day, right? So I'm a long-term investor. I'm gonna hold my stocks, but there's sometimes it's just time to sell, and I'm looking at 3 particular stocks for that. I'm not gonna do anything right away, and I might not do anything for months. I may never do it at all, but there's always something cooking in my mind about something that I want to do. So. Yeah, so that's I have heard that, but I don't necessarily espouse to it, if that makes sense. Fast Eddie in the house. Man, got some good folks here tonight. Let's see. Don't forget that Realty Income is launching a private capital fund that will tap into a huge source of capital. Well, I tell you, they're going to need it because they are huge, man. So, they're going to need some huge capital. Not only huge capital, they're going to need huge opportunities. I mean, if they were to come in and buy a city in Alabama, the whole city, it might not even show up on their financials, man. They are so big. So that's, something to keep in mind about Realty Income. I like them. I certainly understand why people invest in them and have no issues with that. I think they're well run. I think they are a good company, but man, they are getting so big. It's just they're going to need that capital. What would you still own? Yeah, that's a good one. Still own Realty Income. That's good. Let's see here. What else do you guys want to talk about? So let me address John Jay's question. He had 2 of them, I think. One of them was about what is my strategy for preservation of capital, not self-preservation, but preservation of capital. And a lot of people, when they get my age, will say, "Hey, I'm gonna go into bonds. I'm gonna go into real estate investment trusts. I'm gonna go into BDCs. I'm going to go into things that have very little movement. I'm going to go into SCHD. I'm going to get some high dividends." My approach is different than that. I'm looking for total return, and I'm not necessarily seeking to preserve capital. And I know it's going to sound weird, but I use risk management tools to manage risk. And by managing risk, it helps preserve my capital. So, I mean, we saw a little bit earlier. I'll pull it back up here. Just as an example, if you guys were not here and you're on the stream right now, got to find my cursor. My portfolio return year to date, minus 0.47%. It is doing better than all of the indices, all the major ones. And so that in and of itself is preservation of capital, but I don't invest for preserving capital. I invest to grow total return, but I try to get there with stocks that help manage risk. And I know it sounds complicated, and I guess it could be, but That's just the way I think about it. I don't think about, hey, I need to be afraid of losing my capital, because while that's always a risk, I do the things. And I think I did a video on that, and if not, I will do it on the things that I look at. The things, like diversification, for instance, is a risk management strategy. So if you are not diversified in your portfolio, you are open to losing your capital. Doesn't mean you can't lose it if you're diversified, but you can lose less because you're more diversified. So anyway, so I look at it not as capital preservation, but as risk management. And there's things that I do for risk management. The way that I research stocks, for instance, when I'm looking for, how the management team runs, what their financials are, what their valuation is, what their capital allocation is. I look at all of those things in a business, and that due diligence is a form of risk management. So hopefully I'm tracking with you guys on that. So hopefully that helps. And then the other thing he wanted to know about was SCHD. Why am I not invested in SCHD? First of all, I think, SCHD is fine. It is a great tool for people who aren't involved and really don't want to be involved in picking individual stocks. I think it's a great way to get some current dividend income. I think the model works for them because they are not concerned about keeping a smaller basket of stocks. They're 100, 103, somewhere along in there, different stocks in SCHD. So they are they have the ability to really super diversify over 100 stocks. Still don't get rid of all the risk. You never get rid of all the risk, but they're able to cover the risk of their model failing on one particular stock because they have 99 more that are pulling through. So I enjoy picking individual stocks. I do have two. Is it two? I think I have two ETFs in my portfolio. One is VU, which is the S&P 500. I have about a third of 30% of my portfolio in that. And then I also have SOX. And where's SOX at now? SOX is SOX is SOX is 2.5% of the portfolio. So I've got about a third of my portfolio in ETFs, but not SCHD, because I think what I'm doing with my portfolio is what I would expect SCHD to do. So if I weren't investing in individual stocks, I might pick SCHD as an ETF, and then I just let their methodology run and not worry about which stocks they're picking, because I would just leave it there. But I like doing it, so I don't invest in SCHD for that particular reason. So anyway, John Jay, I think that was your question. Hopefully I was somewhat clear on that. Let's see what else we got here. Yeah, I think that's right, Russ. Realty income is for steady, slowly growing income. That is exactly right. That's why we would invest in that. Hey, my friend, Fenders 53, Mr. Income in the house. Good to see you, my friend. Let's see. Man, this hour it's flown by. Let's see. Did I see what Court did today? I'm going to have to look that up. I'm not even sure what Court is. CORT. Corcept Therapeutics. Let me switch over here so you guys can see what I'm looking at. Oh, that's not it. Let me move this over here. That's probably the easiest way to do it. So here's the overview. This is on Tip Ranks. And wow, for the year, they're up 343%. Year to date, they're up 126%. Today, what did they do today? They're up, man, they over doubled today. That is incredible. I don't know anything about them. I don't know what they do. They're therapeutics, so there's got to be in the medical field. Um, but I don't know anything about them. They don't have a dividend, and but something good must have happened for them. Let's see. Oh, Rocket acquires. Maybe target price raised to 128. Wow. Yeah, I don't know why. I don't know anything about them, but that is really cool. Congrats to whoever held that, because that is a big, big move. What do I think about Caterpillar? I think Caterpillar is a good stock. It's on my list. I think they're well run. First of all, they are. Let me switch this back so you guys can see. Let's see. Where are they? They are about number 20, but I have some hidden because I have some ETFs in here that I don't do buy sell ratings on, so I get them out of the picture. They're about number 16 on my list. I see about a 16% annual return potential for them. Let's see what the analysts are saying. Analysts are saying 22%. So that's pretty good. They've got a wide moat. They are undervalued. They have a 19% return on capital. Anything above, let's say, 9 would be fantastic. So I think that is good. They've got a 93 dividend safety score and a medium uncertainty. So I like Caterpillar. And so if I were to research Caterpillar and fall in love with it, I would go, wow, I'm going to invest in Caterpillar. And it's a great company to invest in. But my model says there may be some better ones. And so those are the ones I'm going to stick with. And some of those better ones are Google, ConocoPhillips, Amphenol, Microsoft, Carlisle. So you get the point, right? So this is kind of helping me focus because I want to keep somewhere between 15 and 25 stocks in the portfolio. What am I at now? Let's see. Currently at 25 holdings in the portfolio. So I'm kind of at the top end of my list. So I don't want to go crazy and buy a bunch of different stocks. I want to try to focus on the ones that I think are going to do the best over time. If you're dueling, Michael says, if you hear dueling banjos, Russ, you probably better run away. Yeah, that's probably good. That's probably the best advice I've heard all day, Michael. So let's see. Ta-da. Looking for a good industrial stock. So first of all, I think Caterpillar is a good industrial stock. I think Carlisle is also a good industrial stock. It is actually one that's on my buy list. So I think that's also a good industrial stock. I also have a column in here somewhere that tells me what sector it's in. So let me see what industrials I have in my list here. So we got Carlisle. Comfort Systems. This is an interesting one. I think the analysts are really loving this stock. They're saying it's going to grow 72%. I'm thinking it's more like 18%. They have been falling like a rock, though. So I think it's a great business to be in. It's basically heating and air. And they buy, a lot of companies. So they're nationwide, and they're kind of consolidating what would be a fragmented heating and air business. So I think they're pretty good. Their balance sheet is good, but they are falling on hard times. They got a 29% return on invested capital. So, if that's something you're willing to take a risk on, I think it would be worthwhile. It's something to look into anyway. I don't own them, and I don't have them on my buy list, but it's really an interesting story if it's something that you wanted to look into. I think Northrop Grumman is still in a pretty decent place. Although, with these defense contracts being canceled and stuff like that, I'm not really investing anything in the defense sector, the national defense sector. Not wild about Stanley at the moment. A.O. Smith is not too bad. Yeah, so I think everything else kind of falls a little bit lower for me. So those are, from an industrial perspective, those are my industrial thoughts. Legendary. I don't know if I've said hello to you, so welcome to the program, man. Let's see. So growth tapped out. All right, Shannon. Good to see you, man. Glad you survived those storms. Yeah, Michael's got a good suggestion. Waste management. Let me see if I can find that. Yeah. So, interestingly enough, Waste Management is definitely worth considering. They're a fantastic company. They're well run. They have a lot of growth. But let me share this with you. They are number, let's just say 87 on my list because it's row 87. And so I think they're overvalued, and there's just not a lot of return potential. Now, I will say this, that there's a lot of emotion that goes on in the stock market. So just because my numbers say that it's only going to return 5%, if there's a lot of herd mentality and people are like, oh, we got to get into waste management, and they drive waste management's price up, then it's going to grow. And it's not because of the fundamentals of the company. It's going to be because the market has sentiment in that direction. So, so it's, I'm not trying to predict the stock price. I'm just saying, what would the stock price do based on the business? And, who knows what the noise in the market's going to be. So Waste Management, I think it's a good company. I would not buy it at these prices. So I think it's way overvalued. That's my viewpoint. Yeah, Mr. Income is the legend shaping. He sure is, man. Let's see. Do I think EPD will go on a dip anytime soon? I'm going to use this as kind of my last one. I don't even know if I have EPD in my... I probably don't, and I'll tell you why. Let me just look. Enterprise... no, I don't. They're not in my spreadsheet. And if my memory's right, they are a... Canadian company, and it's not that I care if they're a Canadian company, but it's about the taxes and the way it shows up on my tax return. So I tend not to deal with companies who have foreign dividends unless there's a 0% tax, and there's some of those like Britain. Is one of those. So I would consider, like British American Tobacco, for instance, I would consider that. But that's so let me look. So will it go on a dip anytime soon? Let me see where it's been. I don't follow them, but I'll give you my thoughts on it. Let me share with you guys what I'm looking at here. So for the day, they're kind of flat. 5-day, 3 months. Looks like they have been on a tear. Last 6 months, they're up almost 20%. Year to date, they're up 11%. I think you might have missed it, man. Yeah. We'll go on a dip anytime soon. I thought you meant. I'm sorry, I read that backwards, Antonio. Will it go on a dip anytime soon? It looks to be. Let's look at a 5-year view. It does move up and down, but it does have that upward trajectory. So I don't know, man. I would say, set your value for that. Set your target price for that. If it hits it, great, buy it. If it doesn't, there's other fish in the sea. So that's kind of the way I would think about that. This is from Gant. Hey, welcome, Gant. I don't think I've said hello to you either. Do we pay foreign taxes on the dividends and the capital gain, or just the dividends? If you have any idea, thanks. Yeah, I don't have any idea. No, I'm just joking. What happens is that when the dividend is paid, at least this is the way it worked for me. When the dividend is paid by your brokerage, then they will actually withhold the foreign tax at that point. And then when you file your return, you get taxed for the qualified or unqualified dividend. And then you file a different form to get the amount that was withheld from your brokerage back on your tax return. So, I mean, we're going to pay tax on dividends. We're going to, and now EPD is, I think it's going to be a K1 company, if I'm not mistaken. So they're at a tax advantage anyway. But regardless, we're going to pay whatever taxes due on our dividends. We're going to pay whatever taxes due on our capital gains, and that would be here in the U.S. However, we do have this complication. It's not a huge deal, but it's just I got too much going on in my life anyway. I don't need to add this kind of stuff where they will actually withhold that foreign tax. And so you're getting it withheld when they pay you your dividend, and then you're paying tax on it again on your tax return, and then you have to file to get the other one back. So I just don't. This doesn't do anything for me, man. There's a lot more fish in the sea. So hopefully that makes sense, Gant. If not, let me know and I'll try to do it better. Yeah. Hey, this is a good point. So, guys, what I'm thinking about doing, and maybe you guys can give me some feedback on this. I'm thinking, because every week I update this spy list, I'm thinking that the appropriate place is to post that on my Discord. The Discord is free to join. You're welcome to join that. If you've never been on Discord before, it's just like it's a chat room basically, and it's just organized so that we have different discussions about different topics, and it's very organized. So I think I may post that in there, and I may then do a short video each week on any additions or deletions from the buy list. So let me know your thoughts on that. If you're watching this not live, if you're watching this on the replay, give me some comments in the comments below about whether you think that would be worthwhile or not. So that's what I'm thinking about. So I appreciate your feedback on that. And yeah, so L Dynamica, let me look that up real quick just to make sure I am not dreaming things. Let's see, show more. Here, I'll look it up on Simply Safe Dividends. I know where it is there. Yeah, their midstream services. North America. Let's see, they have, so they're K1 for sure. It doesn't say. They're trying to keep it a secret, man. Let's see where else I can find it. See what Morningstar says. Yeah, I can't believe I can't find that, because normally it's like the very first thing I see. Yeah, I don't know. Does anybody else know? I don't know. I thought it was Canadian. Thought I had invested in it and at one time and got I forget what it was. It was like, I don't know. They took some money out of my account. So let me know. What do you guys think? Yeah, all right. Okay. Oh, Enbridge. Yeah, I'm sorry. I got them confused. So Michael's always there to help me out. Um, oh, there I am. Here we go. All right. So Michael, you are the man. It I had Enbridge and Enterprise Product Partners confused. So Enbridge is who I had invested in. So everything about the Canadian part of that, forget about it. It is EPD is not Canadian. It is Enbridge, ENB, who is Canadian. So sorry about that, guys. It's been a long day, maybe. So Michael buys gas from Enbridge. And yeah, Billy, you're right. EPD is an American company. You are 100% right. And I just had them in my mind as Enbridge. So sorry about that. I'll take the L for that one. And well, guys, we have gone way over tonight. I appreciate you guys being here. I've missed you guys. And let's do it again next week. And let me know again what you think about the idea of seeing these picks every week. So especially in the Discord or even on a video. So, hey guys, with that, I'm going to get off of here and I will see you on the next one.